Welcome to Property Pursuits. We're so happy you're here. As you'll see, we have a guest.
Hi.
Lee Stevens.
Where do I look? You there?
No, at us. Ignore
Okay.
the cameras. Ignore the light. Off camera, we have Michelle.
Hi, everybody.
She is the podcast guru, and she just gave us all our rundown of not being allowed to cackle
Or clap. Or clap.
Or talk.
Bang the table.
or be highly unpredictable, which should be perfectly fine.
Yeah.
Lee, why don't you introduce yourself and tell everybody who you are?
So my name is Lee Stevens, and I'm a local realtor here, and I have a team of 30 agents.
Does that make you the biggest team in Nevada?
The second biggest. No, not even the second biggest team, but by volume, by transaction volume, we're the third largest.
Who is the biggest one in Vegas?
No, the biggest one is the Nevada group.
Oh, we talked about this.
Yeah.
Sorry.
Shout out to the Nevada group. Thanks, Shivani.
I retract that.
Perfect. Yeah.
Okay, what else do you do, Lee? Tell us about your life.
My life. Well, I have a family of 6. I've got 2 18-year-olds. I've got a 6-year-old daughter. I've got a 2-year-old daughter, and I'm married. And I like to hike. I like to play some video games sometimes. I'm into Fallout right now because that show's off the hook if you haven't seen it.
What's that show about?
It's about the end of the world and like
I'm watching
wasteland.
Walking Dead right now.
Yeah,
Because I had never seen it. Did you watch it?
Part of it. I couldn't get through all of it.
I've seen it.
I'm very, it's creating a lack of sleep. So if I stumble on my words today, or if I don't really know what's going on, it's because I don't sleep anymore, because they're only 30-minute episodes. So you're like, I'll watch one more.
Yeah.
But then also I'm already a highly stressed out person, not because of real estate in any way.
No.
But then when I watch Walking Dead, I get more stressed out and then I
Yeah.
can't go to
It's
sleep.
so gory too.
It's pretty gory. Yeah.
I watch shows like that, and then I get these like nightmare like little snippets. They'll go for a couple weeks, and then I'll do something else, and I'm like, oh wow, I can sleep again. Weird.
Okay, speaking of gory, you know what was not gory?
Hmm.
Mortgage bonds this morning.
Oh, good.
Okay, so it just happened. We were waiting. The news came out at 11 on what the Fed was going to do. And we were really nervous because interest rates have been ticking up the last 2 weeks. It's been pretty uncomfortable for us in this space.
Yes.
It's felt very warm. Okay. But we were wanting to see what they were going to do with not just a rate hike, but also Sandy, with the whole like,
The runoff of the balance sheet.
can you explain that to people?
Yeah, so one of the ways the Fed can stimulate or increase or decrease interest rates on mortgages is how much of the bonds they're buying. And bonds are basically like packaged mortgages. So when they buy a lot, it increases demand for mortgage bonds, therefore lowering the yield, which directly lowers mortgage rates. So when the Fed is replacing loans that are paid off or just doing a lot more buying, that essentially will help with mortgage rates. So with them increasing the buying, that should be a positive impact in our world.
Cool.
She's so hot. Just
Yeah.
smart.
Yeah.
So what she's talking about is that people generally think that the only impact the Fed has on interest rates is the Fed funds rate.
Mhm.
And that's the only lever they pull
Okay.
up and down to move interest rates. And the Fed funds rate is not directly the mortgage interest rate, but it heavily influences it. It's the short-term rate. So we were watching today to see if they were going to hike. Thank God they did not hike. They didn't cut either. But the other thing that people are less aware of is what Sandy just explained that drives mortgage interest rates a lot. It's how they carry and manage their balance sheet. And so we were worried they were going to say that they were going to offload a bunch of bonds and that would hurt supply and demand. And we would see a really bad reaction today if they hinted at that, but they didn't. So we're in good shape on that front. And then they said that the inflation data has been sticky. No shit, Sherlock.
Yeah.
And so they haven't seen what they need for a cut, which is, I think, impacting our industry a ton.
Yeah, it is.
But in my opinion, I think it's impacting realtors and lenders' mental health more so than the actual activity of buyers, because we've seen a ton of activity last few weeks as interest rates were climbing.
Yeah.
Things have actually gotten hotter out there because it's spring and summer buying season.
Right.
But when you look at realtors and lenders who were told that we were going to have 3 rate cuts this year, things were going to get so much better, and like it's been jerked around, then realtors with the NAR lawsuit, which we won't dive into today because we talked in detail about it last month.
Yeah.
But I think that if you know a realtor or lender, you should probably be checking on them. So how are you doing, Lee?
I'm doing okay.
What about like all these realtors you manage and the ones you meet? Like, what are you getting as the vibe within our industry?
So I focus a lot on the data. We meet weekly. I condition them to think positive and deal with the traffic that we have. You know, we're really large because we have a lot of leads. So we feel the activity totally differently. When when the rates hit or something like that, when the rates really go up, it really does slow lead flow for us. Right now it's picking up, and the attitude is that people are buying no matter what. People are selling no matter what. And so we're focused on those clients, and we're using a system to kind of categorize people to make sure that we're focused on the people that really want to move right now. And things are totally possible if you're out there looking and you're open to the process.
I think I would agree.
Yeah.
We see that if people are flexible, they're finding a way to get into a home.
Yeah.
Sandy's coming up with solutions for them.
Yeah, I just restructured a deal. We had a strategy. Curveball came up. I was like, it's okay. I still got this. Let's go. So
Curveball. You call them curveballs. I call them face slaps. Yeah. Just getting slapped in the face. How many times is
yeah, that's
Teal gonna?
maybe more accurate.
Yeah. Yeah. Oh,
She just told us not to cackle.
are we cackling? Oh. Nice.
Okay, sorry, everybody. So big news this today to stay on track was Fed meeting. Were they going to do something that was going to be bad for bonds? They did not. Right before we got on, I checked and mortgage bonds were in the green 25 basis points. So that's good. If you're out making offers this weekend, hopefully we see this positive movement carry on through the rest of the week. And maybe you have an 1/8 of a point better interest rate come Friday. That would be so nice. I'm putting that out to the universe.
Yeah.
Now, what happens with rates? What's happening with your realtor's mental health? What's happening with who's paying the realtor? It's a lot of noise right now. Like
Yeah.
there's so much noise about whether to buy or not buy. And I was thinking about, so I remember talking to people in 2017 who were like, I'm gonna wait.
Oh yeah.
And people expect us on this call, they would expect the three of us to say, don't wait to buy because we want you to do it now so that we can stay in business. But in reality, there's a very like proven set of data here on what happens with home values and how waiting doesn't serve people. And Sandy's gonna talk about that.
Yeah, so we talk a lot about how real estate is a great way to build wealth because you can use leverage, you have amortization or your loan pay down. There's just so many factors. But when we talk about that trope that real estate always goes up over time, we just wanted to talk about that because it does always go up over time. So this chart is showing you the home prices from 1902 to basically current. So the blue line is the nominal price of real estate or the actual sticker price that you'll see the home listed on the MLS. The orange line is inflation adjusted prices. So this takes into account the cost of everything going up and how does the buying power that your dollar has change over time. So this is really important because if your home goes up in value, but then everything gets more expensive, you feel like you have a more high priced asset, which is true, but does inflation offset that? So that's what this chart is really cool. So if you look from 1900 to basically 1970s, you can see that the inflation adjusted stayed relatively steady, while the actual price was just ticking up slowly. This is really good because it's a hedge against inflation. So not only is the mortgage that you're paying locked in at an interest rate based on previous cost of money, but now your home is going up in value to offset that cost of inflation. So yes, you have appreciation, amortization, all those other tax benefits, but you're protecting yourself against other costs going
So
up.
pause for a second.
So that was a lot of words.
Because so what you're saying is when you buy a house, you take out a 30-year fixed interest rate. Typically now is the most popular loan product.
Yeah.
So you're buying your home at the cost of money that day.
Yes.
If the cost of money improves, you have the ability of refinancing. But on the other hand, if the cost of money, what's the opposite of improves?
Declines. Good.
Yeah.
Worsens?
Yeah.
Worsens?
I was like, deproves?
Worsens.
I'm going to bed on time tonight.
Me too.
If the cost of money worsens, then you can leave. Did you eat lunch?
No. I need a cheeseburger right now.
These just growled so loud that I lost my train of thought.
It's probably. Oh, nice.
It went really loud in Michelle's ear.
I'm dieting.
Okay,
Dieting.
good for you, Lee. I'm
Yeah.
proud of you and working hard for your goals.
Thanks.
Okay, so if the cost of money gets worse, you have still set your housing expense based on a previous cost of money.
Mhm.
And that's how, I mean, to put this very layman terms, you know what your housing expense is going to be for 30 years, regardless of what happens with the cost of everything else.
Mhm.
Right.
So it's a built-in protection plan against inflation. But what Sandy's outlining is at the same time, if the cost of things is going up, that means the cost of your house is going up while the money you've paid for it has been set on better terms.
Yes. Yes, exactly. So then when you have your fixed housing expense and you get a raise, yeah,
That's great for you.
your inflation, now you got a pay raise. Now your cash flow is just better. So,
I have a real life thing that I say to people, and that's if you ask someone who's purchased a home since 2008 if they should have waited longer, just ask them that question and see what they say. None of them say, "Yeah, I wish I would have waited an extra 2 years." And so that's what I tell clients when they meet with me. It's like trying to time the market. It's gone up consistently since I've been in the business. And even with all the different things, all the different factors affecting the environment, home prices have still increased, and that's due to a lack of inventory, and that's not changing anytime soon.
yeah, exactly. The inventory, location. And even if you did buy at the wrong time, like my mom's house is a perfect example. She bought her home in 2003 for low 300s. It sold last summer for almost 2.5 times as much. So
Yeah.
She bought at a high time.
she bought at a high time. She sold in 2007 because of a divorce. So, I mean, nothing you can really do about that. Sometimes circumstances are circumstances. But yeah, bought at, one would say, arguably the worst time, sold at arguably the worst time. And then still, if she had held that, it would have almost 2.5x in value. So even when we see real estate not go up in a straight line, over time, it does go up.
Absolutely. I always tell people that you only lose if you sell. So don't sell when it's a bad time to sell. I mean, it really affects like flippers, like the whole market
Yes.
going up and down. But if you're planning on living in the home for 5 years and that fifth year comes up and the market's down, just hang out for another year. You can afford the mortgage at that point, and then you'll exit with a great equity position.
We have flippers who register for this webinar.
Okay.
And typically it's not who we're talking to, right? We're giving advice to home buyers, move up buyers, and people wanting to invest in real estate to build a portfolio.
Okay.
But like we know Anna Kara in the mastermind,
Yeah.
and she's flipping homes right now. Overall, when I meet with buyers and I go over the data for Washoe County, I'm typically saying it's not a flipper's market. But with the disclosure that there are people out there who very, very much know what they're doing and know how
Yeah.
to identify these deals. Flipping is happening. It's just, I'm not extremely well versed on it. I'm not doing it right now. And when I
Yeah.
look at the data of like what you'd pay for closing costs and then paying a realtor to sell your home, see how that goes, then in the first year or two, you could lose money. So for all the, average homeowners, potential homeowners, move up buyers on this call, it's true. If you're planning to hold real estate and live in it for a few years or longer would be great.
Yeah.
Then you're going to see the reward of this graph where values go up.
Yeah.
Yeah.
That's-
Yeah, exactly. And so I kind of wanted to also talk about,
Kind of wanted to, or really wanted to.
I really wanted to talk also about, right, because it can feel daunting. When I was researching this, the average price of homes has increased over 2,000% since 1963.
2000.
2,000% since 1963, which feels insurmountable. And like,
That's like my mom's lifetime. My mom was born in 1954.
that is my mom's lifetime.
So the cost of real estate has gone up that much percent in our parents' lives.
Yeah.
That's crazy.
Yeah. So the interesting thing is when you look at it, inflation adjusted, the cost of building is this next graph up here. That's almost exactly the same. So we've seen home prices go up, one, because of inflation, two, I mean, because we just see natural appreciation over time in real estate because of limited supply, location, all of that good stuff. Especially in our market, we're seeing influx of people and not enough homes, not enough land. There's legislation to work on that. But when we look at the construction cost, we're seeing the home prices go up so much because home size has increased so much. More have
Oh.
air conditioning now, more have a third bathroom, and they're just getting bigger. So that's a big reason too that we've seen the increase in home prices is we're just buying bigger homes. So So yes, all of this to say that this is all interesting and everything, but we need to talk about affordability, right? So, this is showing you that real estate is a great investment and a protection against inflation and all those things that we always talk about. But we just need to work on strategic, creative ways to make affordability happen, to get you into a home, to start capitalizing on these things. Yeah.
Because home prices going up is a problem. Home appreciation is sweet.
Yeah.
So it's a problem when you're on one side of it.
Mm-hmm.
On the other side, it's a return on investment. And that's what we're here to do, is help you get from this side over to this side, where the value of real estate going up is something that makes you very happy.
Yeah.
Am I okay to go to the next slide?
It's pretty predictable. I mean, I tell people like you've got to decide at what point, at least like the latest point in your life, where you're going to get in the game. Because if you never do, you're going to miss out on all those benefits that we were just talking about.
Get in the game.
Yeah.
Yeah, and I was just
Put your
talking
chips
to a
in.
couple yesterday about this kind of being their retirement plan.
Yeah.
They're like, I'll buy, we'll pay the loan down, the property will go up in value, and then when it's time to retire, we'll switch into a reverse mortgage. Won't have a housing expense. We can live off of all that equity and investment that we've been building. So
And reverse mortgages aren't like shitty, dicey loan programs.
Yeah.
They've come a long way.
yeah, they're a cool financial planning tool.
Yeah. There's two options. I like it too. I understand it.
I don't, so I'm not gonna talk about it. Really.
Okay.
The retirement strategy thing, that's what me and my husband started doing, is that we wanted to buy these properties, have the mortgages be paid down while we're working, and then when we're retired, it's supplemental income.
Yeah.
But then once you get further into it, you start seeing more benefits of investing in real estate. This year is the first year I'm taking the designated real estate professional.
Nice.
That is awesome.
Yeah.
So now I'll be able to take my Schedule E they were passive losses because it was an active income. But if you're a real estate professional, you can take it as active losses against your active income.
Yeah.
Which is the American dream, to live
Yes.
tax-free.
For 27 and a half years, right?
With the accelerated depreciation.
Yeah. So if you bought a home for $270,000, you could take 10 grand off your taxable income per year. That's a total ninja way to do that. It's really cool.
And we're doing a cost segregation study on one property.
Oh,
So we're
nice.
taking our tax bracket down from 32% down to 24%. It's like, this is
That's
the coolest.
yeah,
Check it.
that's talking
Yeah.
dirty to
Wait
me
to
right
do
now.
that.
Yeah, that's good.
I just filed with Schedule E, and it's cool because I rent my primary out to roommates, and
House hacking.
yeah, and claiming that income actually like increased my tax return. So it like the tax benefits, a lot of people when they were getting mortgages at 2%, it didn't feel it because there's
The mortgage interest.
you
rate
have
went
to
below.
itemize all that stuff, but there's so many ways as you begin to build your portfolio that you can really take advantage of tax benefits.
And that's
huge.
the whole tax code was built in favor of real estate investors, I feel.
Yeah, the tax code is just an incentive plan. Like it literally tells you what you're supposed to do to avoid paying taxes.
Legally.
That's right.
Legally. We only tell you legal advice.
Yes.
I don't remember which one of us is supposed to tell them.
This one's mine.
Okay, good. I did not know what I was supposed to say.
Oh, hey.
So this kind of goes into the like real estate retirement planning in a way. So a really cool strategy that I love sharing with our move up buyers is to keep your current residence as a rental property, because you can continue getting all those benefits we just talked about.
Is that something you ask people when they call you to list their house? Do you say, have you thought about keeping this?
So I look at it, I have this like graph with 4 sections, and I look at it as an investment opportunity because I want to build their wealth. And
That means you're a good realtor.
yeah. So does it make me sad when like they hang on to the home? No, because that's how I get referrals and that's how I actually help them. And usually they still buy a house, and eventually with their primary, they'll need that equity to move up, and it's fine. It pays off. But you can't be like thirsty. You can't be thirsty for every deal. You've got to really look out for everyone's best interest.
At the Futurist Female, one of our speakers was talking about how she had bought, before she became a realtor, she had bought and sold so many homes. And no one had ever asked her, have you thought about keeping this instead of selling it so you could start building your portfolio?
Yeah.
And it's true that is the most accessible way, which Sandy's about to get into.
Yeah, I love it. Especially we're seeing it be really pertinent right now because a lot of people who are considering doing a move up have really low interest rates on their current home.
Mhm.
So that's like an asset. If you can hang on to that, that's amazing. So keep your appreciating asset and then move into a new primary residence, do your upgrade. have the room for your family, all that good stuff. It's not actually that hard to qualify for either. You just need to qualify for your new mortgage and have a 5% down payment. But if sometimes we can even still use the equity from the current home to make that happen. But essentially, how we qualify for that is we'll do your pre-approval. You'll start shopping for a house. Once you get in contract on that house, you'll line up a tenant, get a lease agreement signed, security deposit, first month's rent. You'll move, new tenant moves in right after. We're using that rental income to offset your mortgage. So you just need to make enough to qualify for your new mortgage. And now you have 2 units and you did that with a 5% down payment.
And you get to start doing all those tax games we just talked about because you now have a Schedule E rental property.
Yeah. You're an investor.
Yep. And you got primary residence financing on that investment property.
If you keep doing it this way, if this is the way you go about building a portfolio, you could acquire several houses with a minimum down payment program.
Some people do that. They move every year or two.
Yeah.
I have friends who actually flip, but they move into it, do all the things, live there for a year or two, buy the new one, sell it.
Because when you take into account the budget of flipping, they would have been paying for a place to live anyways. So since they're living in it while they're renovating it, it makes the net profit more pencil better.
Oh yeah, definitely.
Definitely a hack.
But then you have to live in a renovation. So
I don't think I could
personally, not my strategy, but
How would your marriage do during that, Lee?
It'd be rough. Yeah, just the constant like hammer swings. Ding, ding, ding. Have you done? Oh, you did, right?
We built an addition onto our house, and the GC who originally built our house lives up the street.
Okay.
And so he helped Josh just do like pull an owner build permit and like,
Nice.
oversee this whole thing himself.
Oh man.
We had a newborn at the time.
Anything. So for me, the rule of thumb is anything over 10 or 15 grand, you should hire a GC because you're not a freaking GC and you can't manage managing contractors is like next level game right there.
Because people don't realize I was just talking and she's on the call, but I had clients that came in this morning and I was talking to them about that. And I think what you don't realize is that this guy, say it's the excavator or somebody.
Yeah.
He's supposed to come today.
Right.
And 3 other people are lined up for later this week after him. And everyone's very busy.
Right.
And he doesn't show up because he's drunk.
Yeah.
And then now nobody else can come to do their thing and they're booked out months.
Yeah.
So now you're just sitting like trying to scramble. That was stressful. But anyways, that's another tangent that we weren't going to talk about today. This backed by gold thing. So this is totally just like hearsay, or I want to just talk about this. What I'm saying is I don't have a data point for this. I tried to find one and we could not, but I feel it. Why are people spending so much money? We started talking about the Fed meeting and we're talking about how inflation's been sticky.
Yeah.
And what I can't seem to figure out is where people get the money to keep driving up inflation, because credit cards are maxed out. Delinquencies are at their highest point in recorded history. So that means people are not making the minimum payment now on their credit cards.
Yeah.
Savings rates are in the shitter. And I cannot imagine a world in which the stimulus money has not run out.
It's out. So they're, and I see this going on listing appointments. I've tried to help multiple people move out, but they borrowed the money from their house. So, and why they're doing it is because it's a habit. It was a habit induced during COVID, spend all the money. Let's keep the economy running. And then as the funds ran out to supplement that, they started reaching into their credit cards, which is what you were just talking about, and now into their home equity. And it's actually, that's another reason why inventory is pretty tight, is because some people are trapped, even though they want to move up, move out.
You're seeing when you go on listing appointments now that people have tapped into the equity of their house so aggressively that they can't sell it because
there's not enough. They could sell it like flat, yeah, but then they don't have the down payment needed to move into the next house.
We haven't even thought of that or talked about that yet.
Yeah, I saw it 3 times this month. So it's a thing.
It's so interesting because then you see other articles that say home equity is at such a high, and
the thing about data, and this is the Fed's problem too, it's everyone's problem, is we see the data on a delay.
Yeah.
So we're seeing homeowner equities at an all-time high. We've been seeing that for like the last 12 months, but the data is not yet reflecting what's happened in the last 12 months where people started tapping into that equity.
Yeah.
We've had more people reaching out to us for HELOCs. So that's in line with what you're saying. So that speaks to the point now, it's actually more valid.
Yeah.
So I was we have this new project coming on, 18 on Lakeside,
Okay.
18 townhomes that a builder in town, BRG Homes, is putting up. They're beautiful luxury townhomes. And I had a meeting because we have, oh, if you're a realtor on this call, we have a broker open on Wednesday, the 9th at 4. You should come, but it's a construction site, active construction site. So wear your construction boots. I've got construction hats for you. And we'll take some really cool videos on the second or third story of these, where you can see like Mount Rose behind you in downtown Reno. If you turn the other way,
That's
like,
cool.
it's going to be a fun event. Thursday, the 9th at 4 for real estate agents. But the builder was telling me, because I was asking him, I was like, where are people getting the money? He's
Yeah.
like, I think people are backed by gold with their house. They feel like because they have that house, they own that asset, they can keep spending like there's no tomorrow and they'll figure it out later. And that speaks to what you're saying.
Yeah.
That's like, I'm going to ask more agents if they're running into this. Because if you're running into it, that's an indicator that it's happening because of how big your team is. That's an indicator that's happening on a more widespread level.
Right. And it's happening. What I've seen is it's happening at a certain price point.
What
So
price point?
the price point is sub 500. So right there, where we need the inventory the most, where the most active buyers are, that's where the problem is. And it's not like every listing appointment I go on, but I did see it 3 times. So
And
that's
you're right, it is impacting the available inventory that would have come on.
right.
It's 3
Yeah.
listings that would have come on this week that now can't because it doesn't pencil.
That's right.
It's interesting. It's very
Yeah,
interesting.
That's very interesting.
We already kind of talked about this, but Michelle had found data for us on how homeowners carry debt versus renters. And I don't remember what it was. She's saying to me off screen, read the notes I wrote down for you. So renters do typically have lower credit scores. And a part of that is simply that they don't have the mortgage debt reporting to their credit every month. And a lot of times when you rent, you have less, you don't have that line. You don't have that trade line on your credit to help you build credit better. Because your rent, unless you're self-reporting, isn't helping your
That
credit scores.
doesn't, self-reporting rent doesn't actually help your mortgage.
What about
FICO anyway.
what about self-reporting utilities? Does that even help anymore?
Mm-mm.
Not on mortgage FICOs. Other credit scoring models, yes, not on mortgage FICOs.
So if you're trying to get a car or credit line increase.
Have you guys talked about trade
Yeah.
lines before? Does everyone know what that is?
Oh yeah, you're right.
Yeah.
Okay,
so
that's some lingo.
Yeah, that's
why don't
very
you tell
jargony.
us?
Oh, well, I think it's like, I'm not a lender, but I'll guess at it. I think it's, you've got your credit cards, you've got your mortgage, maybe a car. Those are all trade lines that add into what equals your FICO or your credit score. So,
This is why it's good for us to have guests.
Yeah.
so if you're someone who has no debt, I run into this all the time. There's students who have no debt, who have cash, but they have terrible credit because they've never opened a credit card.
Different trade lines.
Right.
Yep.
So,
Trade lines are the things that build your credit score.
Yeah. So you guys want two credit cards. The best tip I have is 2 credit cards. Use them for gas, Netflix, whatever, small things. Keep the balance low, pay it off every month in full. You don't have to pay interest on it. But just do that over time and you will have great credit
and at
and
least
no interest paid.
6 months, is that when
Yeah.
they start to report?
Yeah.
So yeah.
You
Yeah.
know your stuff.
Yeah. I do this once in a while.
We were looking at utilization of how homeowners utilize debt versus how renters do. But the thing is that homeowners typically have a higher credit limit. So they
Yeah.
have the ability where they can, as we just mentioned, they have deeper pockets to tap into pulling more debt out than renters do, because one, they're likely to have a better credit score. So their credit card's going to give them a higher limit than a renter, but then they also can access additional lines of credit, like through their house, like a home equity line of credit.
Yeah.
So the reason we're talking about debt so much is just because Americans are in a lot of debt right now, and it's impacting affordability,
And
which
inflation.
is Sandy and I's like obsession in life, is how to help more people afford homes. Now, you don't have to wait for this webinar every month. If you wanted to avoid stomach growling, table tapping, and cackling, you could just follow us on socials. We put out a ton of content. Lee does too. So
Yeah.
we included his handle there. We're basically all working to keep in touch with you all month and give you like an honest, behind the scenes, transparent look at what's happening in the real estate market. So if you connect with us on Instagram, you'll be in the loop.
Yeah. Do it.
Go with your success story, Sandy.
Okay. So yeah, go to the next slide.
Yes, ma'am.
So we've been seeing the market pretty dynamic. Certain houses are going well above list and bidding offers, and then others are getting discounts. So it really depends on what property you hone in on, how motivated the seller is. I just had a client, we saw a lot of temporary buy downs last year, and they're continuing into this year, though not as frequently. But we had a client get into contract $40K below list price. with a discount in the price of the home and also a seller credit big enough to do a temporary 3-2-1 buy down, which brought the payment down in year one hundreds of dollars. And then he'll also see lowered payments continuing in year 2 and year 3. And the cool part about the temporary buy down programs is if rates come down and he refinances, some of that credit that hasn't been used up is actually refundable. So it's a really cool strategy if you can get the seller to go for it.
We talk a lot about if we should be recommending this because everything we thought was going to happen with interest rates, the opposite has happened. And so we're like, will people be able to refinance during their temporary buy down period? Well, if we go to a worst case scenario where rates didn't come down enough to refinance, I still believe in this loan program because you saved money on interest over those 3 years. The seller prepaid interest for you for 3 years.
21K in this case.
Yeah, that's a lot of money you saved. Hopefully your income trajectory is improving over the temporary buy down time. And third, you have appreciation gains over that time that you wouldn't have had otherwise.
Yeah.
So I still believe in this loan program, even if we didn't have the opportunity to refinance. That being said, I also believe that rates will eventually come down and you will be able to refinance.
Yeah, I have thoughts on that. I bought a home last year and I got a 7.1 interest rate.
Because he didn't use me.
Well, it was through a builder. And so they had me what I thought trapped. I mean, so I put 30 grand into the rate buy down to get it to that. And it's a little bit of a higher end home. If I would have done a temporary buy down in that case, and I wanted to sell or refinance, at least the money wouldn't be lost. So you put the 30 grand in, and let's say rates do come down next year to 6% or whatever they come down to. Now the money that I put into that buy down is gone. So the 3-2-1 or the 2-1 or the 1-0, good options, pretty flexible. And everyone should know that when you qualify for that, you're qualifying at the highest rate. So even if they don't come down, you're still qualified in the bank size to afford the home.
Yeah, and it is a fixed rate loan. So
Yep.
even if rates kept going up, you'll never pay more than whatever rate you locked in today before the buy down.
Yeah.
And another really good point you just brought up is if you have to sell, like we talk about the refund if you refinance, but if you end up needing to move to take care of someone in another state or whatever, your job. Yeah, that is another perfect example of that. That money is held in a holding account used to subsidize the interest every month. And if you sell or refi, you would get the rest back. So it's a really cool loan program. Big fan.
On it.
Yeah.
And I don't think you should feel bad. I think you got a good deal because where interest rates were at that time that you bought, it makes sense. And you're saving money on interest along the way.
Yeah. That 30 grand was the
And
builders.
And rates are staying higher for longer.
Yeah.
So
Yeah.
That's true.
you still did. I mean, you should have used me,
I should have.
but I understand why you
I
didn't.
wanted to.
I won't hate you for it.
Thanks.
I'll just bring it up every time I see you.
Yes.
So pointer, something that Sandy and I have started doing, and we thought, why not share it with everybody who joins us on these calls? A lot of people think that they're above a budget, right? But just call it your monthly cash flow tracker. So when you come in to see a lender, we qualify you based on your gross income. And we only look at some of your expenses, the trade lines that report to your credit. You have a lot more expenses than that. And there's things that are variable, like groceries, gas. A big one that might not be variable, but should be considered childcare.
Yeah.
Like this stuff costs a lot of money. So what we would like people to do, and what our pointer is for this month is, we have a budget that we created that's really good. Just pop in the chat. The link will be on the YouTube and in the podcast notes, but we can share with you the link to this budget we made to do your cash flow tracking. Look at your net income, what you actually take home after your retirement contribution and after paying taxes, because you're doing that. You're contributing to your retirement every paycheck.
Yes.
And we look at your cash flow at the end, and then we take out your fixed expenses. And then the sheet's going to prompt you to also add in the variable expenses. And what I want to get at is how much money is disappearing at the end of the month.
Yeah.
Like, what are you spending in restaurants, at the mall, at coffee shops, without having really anything to show for it? We've talked about it on the show before. I'm not going to Dave Ramsey anyone and tell them they're going to be able to buy a house if they cut their latte. But I do know that, like, at the end of the month, I feel good if I have really nice new shoes I bought with the money.
Yeah.
But if I just ate things and I have nothing to show for it, then I don't feel good about the spent money.
Yeah.
So if you could contribute some of your disappearing money towards your down payment savings or towards a higher housing expense, it will probably, I know for a fact, it will do wonders for your financial stability.
Yeah. I love that idea. The game changed for me when I started doing a budget. And it's surprising. The first thing that's going to surprise you is how much you actually make a month. You like remember, you're like, I bring in like 8 grand a month, and you're living off of 1,400 because of all the different payments or whatever.
Yeah.
So tracking your gross every month, taking a look at it, and then trying to manage those expenses is really good. Especially just looking at it every month will increase your wealth. You know?
I agree.
Yeah.
Just knowing it.
and I do it every month, and then I'm like, okay, don't need this gym membership, or okay, do I watch Netflix? Yes, that's staying. Like,
Yeah.
so you're just-
$22 a month.
You're just aware of what they are, and you can make the decision if it's worth it or not.
Yeah.
How you spend your money should be a conscious decision, and that's our pointer for this month.
Yeah, because I'm more into eating the things and not buying the shoes. So, personal preference.
What gives you joy?
Yeah.
Everybody has what gives them joy. If you want to have a conversation with us, personal, one-on-one, if you have questions you need us to help you answer, or you want us to strategize, we're available to do that all the time. That's what we do all day, every day. Is actually not put out content. It's strategize mortgages and building wealth through real estate. We do a lot of content creation too, but that's just to help you guys know who to come to when you need a mortgage. Thanks for joining us today, Lee.
Thanks for having me.
everyone for being
Thank you.
on.
Yeah.
We'll catch you next time.
Bye.